California mental health tax. 1 extra percent on income above $1 million, and almost everything written about it describes the resident version only. The authority is Revenue and Taxation Code Section 17,043. California voters added it through Proposition 63 in 2004. It is a flat 1% on the portion of taxable income above $1 million. Not a bracket. A surcharge sitting on top of the schedule that already tops out at 12.3%. That is where the famous 13.3% comes from. Now, a naming change that is catching people out this filing season. Proposition 1, passed in March 2024, renamed the Mental Health Services Act to the Behavioral Health Services Act. The Franchise Tax Board followed, for taxable years beginning on or after January 1, 2025. So on the current return, the line reads Behavioral Health Services Tax. Form 540, line 62. Form 540 NR, line 72. The statute did not change. The rate did not change. The $1 million threshold did not change, and it has never been indexed for inflation. Here is a detail that surprises married couples. The threshold does not double. Section 17,043 expressly switches off Section 17,045, the joint return income splitting provision. So a couple filing jointly applies the 1% above a single $1 million, not $2 million. And now the part that actually matters if you have left the state. On Form 540, the resident return, the 1% is computed on line 19. That is total taxable income. Worldwide. On Form 540 NR, the instructions send you somewhere else entirely. The 1% is computed on line 35. That is California taxable income. Two different numbers, on purpose. The form confirms it elsewhere, because the exemption credit percentage is calculated by dividing line 35 by line 19. So for a non-resident, the surcharge follows the California slice, not the worldwide figure, which makes the move year the year that decides everything. Section 17,041, subdivision I, builds that California figure out of two halves. For the part of the year you were a resident, all income counts, wherever it came from. For the part of the year you were not, only California source income counts. The seam between those halves is the date residency actually ended. So a gain realized before that date is inside the base regardless of source. The same gain realized after it may sit entirely outside. But be careful about what still carries a California source after you go. Gain on California real property does. Compensation for days physically worked in California does. Income from a California business does. Gain on an intangible generally follows the owner. One more interaction worth knowing. Crossing $1 million does two things at once. It triggers the surcharge, and under Section 19,136.3 it removes the prior year safe harbor for estimated payments. Above $1 million of adjusted gross income, paying on last year no longer protects you. Those two rules use different measures, taxable income for one and adjusted gross income for the other, so they do not always fire together. The surcharge is 1 percentage point. Against a salary that is small. Against a business sale it is not. And what decides it is the calendar, not the address.